From a macro point of view, we've seen the commencement of a rate cutting cycle. I wanted to start with a few thoughts on that front. We expect the easing cycle from the RBA to be quite shallow. So they think neutral is around 3.25%, and we're at 3.6% right now. So we think the RBA will have 1 to 2 more cuts left in it. We're not expecting a deep rate cutting cycle, and we think there's a risk the RBA could be raising rates again next year and or the year after that. Interestingly, we've had the return of the yield curve, a positively sloping yield curve, that is. So we've seen the re-emergence of a so-called term premium. So long-term interest rates are now well above short-term rates, with the Aussie 10-year government bond yield sitting around 4.3%. What's also interesting is that you're getting better yields today on bonds than you are on many equities. So the fully franked dividend yield on the All Ordinaries Accumulation Index is actually the same as the 10-year Aussie government bond yield. And I would say, as a general observation, not beating up on our esteemed equity stablemates, but the equity risk premium, or the extra return you get from stocks over bonds, is incredibly skinny. And I'll come back to that in a moment. Another super salient topic on this subject is obviously APRA's decision, imprudently in our view, to completely eviscerate the $40 billion hybrid market, which will disappear by 2032. This is a real problem. We're seeing a profound deterioration in the liquidity of the hybrid market. A super fund on Friday gave us 65 million of hybrids and said, just get rid of them. We're seeing turnover fall, we're seeing wider bid-offer spreads, and obviously you're being spruiked all manner of solutions. And the problem with those solutions is that you're obviously being forced or compelled to move into sectors that have much higher risks than those contained in hybrids. Much greater illiquidity risk, much greater price and NAV risk, much greater default risk, and sometimes some interest rate risk. And we've seen how this ends up in past cycles, such as March 2020. Our solution is a little bit different. Our solution advocates staying with exactly the same issuers, ANZ, NAB, CBA and Westpac, and not moving down the capital structure into the equity junk, but up the capital stack into the senior bonds and subordinated bonds, and applying a very modest amount of gearing. You might say, well, how modest is modest? Well, if you look at CBA shares, they're currently paying 3.8%, fully franked, grossed up for those franking credits. And CBA's balance sheet has 95% gearing. So when you buy CBA shares, you're taking a 20 times levered exposure to the balance sheet of that bank. If you buy a house, you put down a 10% deposit, you use 90% gearing or 10x leverage. You buy a commercial property, you might have a 60% LVR or 66% LVR, you're about 3 times levered. In the case of YLDX, our new ETF, we typically apply a gearing of around 66%, so about 3x leverage. We are currently paying a cash yield of 7%. The credit rating on that portfolio is A+. It's predominantly ANZ, NAB, CBA and Westpac bonds. It's daily liquidity, and in our view, it really cauterizes the key concerns about replacement alternatives. It doesn't have liquidity risk. In our view, it doesn't have default risk. In our view, it doesn't have price and NAV risk, and you're actually staying with exactly the same firms. Just to kind of double down on the equity comments, and again, I'm loath to cast any aspersions against my equity brethren, but you might be familiar with the equity risk premium model that the US Federal Reserve runs. We've taken a derivative of that model and applied it uniquely to Aussie bank stocks. And this is what the middle chart on this slide shows. This is the equity return premium that you get from CBA, NZ, NAB and Westpac shares over the same bank's bonds. And normally those banks give you a handsome return premium of 6.2%. The bad news is today it has plunged to just 3.2%. What this tells you is the big banks' bonds are signalling that the big bank stocks are 48% overvalued. That's the chart on the right-hand side there. 48% overvalued. So a little bit about Coolabah. We run about 17 billion today. We have the biggest team in public fixed income in Australia. Lockie in the corner there has the biggest team in private fixed income, much bigger than my team. But we have 53 professionals around the world in London, Miami, Auckland, Sydney and Melbourne, 4 traders in London, a trader in Miami, 11 traders overall, 21 analysts. We are the single biggest trader of Aussie bonds globally. We are the single biggest trader of Aussie Commonwealth government bonds in the world today. One of our newest strategies, just as an aside, the Sovereign Bond Fund, which we recently launched with commitments of about $500 million, over the last 12 months has returned 8% net of fees and is AAA rated, and we'll talk about that later. So we have the biggest team, we're the most active player in the market, we're highly quantitative, we have 80 different bond pricing models, and what we're trying to do is ostensibly quite simple. We're just trying to price the correct interest rate for these debt securities to pay us. We want to buy a bond paying 5.1%, that should really only pay 5% after we account for all of its peculiarities. Its credit rating, its term to maturity, where it sits in the capital stack, how large the security is. And when that bond's yield normalizes from 5.1 to 5, we get a bit of price appreciation, we monetize that. And in global credit, we do most of our trading in US and Euro credit, about a third of our trading in Aussie credit. Our win ratios are 80 to 90%. In sovereigns, our win ratio is about 79% on about $250 billion worth of sovereign trades. So in fixed income, everyone talks about yield. And the way you drive yield is through illiquidity and private debt, through credit default risk in high yield bonds. We've got speakers, interestingly, on all these topics today. Through interest rate duration, through taking a fixed rate rather than a floating rate exposure. And at Coolabah, we try and minimize these betas. So we run hyper liquid portfolios. We turn over our sovereign fund over 100 times a year. We are not interested in taking any default risk. You guys were pushed those Virgin Airline notes, and many of my peers, the credit funds, loaded up on them. They ended up being zeros. We wouldn't have touched that with a 40-foot cattle prod. Many credit funds in Australia own those Credit Suisse hybrids, which was zeroed in March 2023. $27 billion of Credit Suisse hybrids disappeared. Our credit analysts put a ban on Credit Suisse in 2021, and we were shorting Credit Suisse in 2022. So we just want to deal with the safest, most liquid securities in the world, and we want to price bonds and trade them. Because we're so active, we're like a market maker, and we actually earn transaction costs. We earn the bid-offer spread. So our transaction costs are actually, really interestingly, negligible. There's 7,000 investment-grade bond issuers around the world, and we only allocate to 305 of them. You might say, hey, Joy Boy, you're kicking out 96% of the universe. It's tiny. You must have capacity constraints. But those 305 issuers are the mega caps, and they actually account for 55% of the total global investment-grade bond market. So these are the Apples, the Meters. We put 120 million euros the other day into Google's first ever issue into euros. The CBAs, ANZs, the JP Morgans and Barclays of the world. And the key point is we don't want any default risk. As an example, we haven't traded an HSBC bond for years or a Standard Chartered bond for years. We've never traded Deutsche Bank securities. They're just too risky. To give you a sense of the efficacy of our trading, what I've put up on the screen here is every new bond issue, or akin to a bond IPO, that we've bought since 2020. And it's a little bit hard to see the data at the bottom there, but basically you're looking at 28 billion of sales. Every dot is a sale, every color is a different bond market we're trading. The vertical axis is return, the horizontal axis is time. If we're above the loser line, which is the red dotted line, we win. And we make money 92% of the time on these $28 billion of exits, but we're only holding for a very short period of time. Our median holding period is 2 days. Our average credit rating is A, and the typical mispricing we harvest is about 11 basis points. Doesn't sound like much. That's like the bond yield going from 4.11 to 4.0, and that gives us a modest capital gain, if I can describe it as such. And we get that every 2 days. So we get about a 0.5% capital gain every 2 days. If you turn that into an IRR, that's actually 35% per annum. Now, we run 17 billion, but with repo or leverage, the bond book that we are stewards for, our actual trading portfolio is not 17 billion. It's 35 billion. So our AUM is 35 billion, our FUM is 17 billion, and I can't put 35 billion into new bond issues every day. We can only put a certain percentage of our book into that. So I can't deliver 35%, but what we can deliver is very consistent alpha. In the secondary market, we don't hold for 2 days. We typically hold for 1 to 2 months. The hit rate's very similar at 80 to 90%. The mispricings are actually a little bit bigger in secondary, but the IRR is lower at 7 to 8% rather than 35% because we have to get a similar capital gain, about a 0.7% to 0.8% capital gain, but we have to wait 1 to 2 months rather than getting 0.5% every 2 days. But this process works all around the world. It's very consistent. It works in all market conditions. If credit spreads are widening, tightening, not moving, and it's totally unique. A big global asset allocator, it's public information, but I won't name them, but a large allocator recently gave us over $1 billion, and they tried to allocate 15 billion US. And they said they'd never seen a manager like Coolabah anywhere in the world. And that's been the consistent feedback we've had from every single, without exception, every single institutional investor we've met overseas and locally. Our style was totally differentiated, totally unique. And I think we're the first Aussie fixed income fund to really raise a lot of capital offshore for global as opposed to local products. Coming back to solutions, just in kind of closing, many of you would be familiar with the very popular floating rate high yield fund. We launched this a couple of years ago. It's about 2 billion in size. Current yield is 6.9%. It is the world's first ever geared bank bond fund. You buy equities 20 times leveraged, but you won't buy levered bonds from exactly the same companies, the ANZs, NAB, CBAs, and Westpacs of the world. So we thought, why not? And actually, it's a good trade because the bonds are a hell of a lot cheaper than the equities, as I showed you. The equity risk premium is at all-time lows, whereas actually spreads on major bank senior bonds right now are about average. Subordinated bonds are a little expensive. Hybrids, heinously expensive. Hybrids normally pay you 3 to 4% over cash. Right now, the yield on a 5-year major bank hybrid, as you can see there, the top blue bar, is just 5.7%, so 2% above cash. So we're giving you 7%, more than 3% above cash, with a much higher rating, and we'll discuss some of the characteristics in a second. But this portfolio offers quarterly income. It's a fund available through the platforms. It's A+ rated. It's fully floating rate. It can only invest in Aussie dollar bonds and daily liquidity. So it really, in our view, has no interest rate risk, credit risk, or default risk, and it's recommended by Lonsec and Zenith. It's on most of the platforms. Because of many of the folks I can see in the room today, you came to us and said, well, we want a listed alternative to this, a listed version of floating rate high yield, and we created it for you recently. So in March, we brought to market YLDX, Yankee Lima Delta X-Ray, or YieldX, whatever you want to call it, the global floating rate high yield fund. Basically an ETF version of floating rate high yield. The only difference is beyond being listed, and actually as a wrinkle, it's also available as an unlisted fund. So this fund is actually 2 funds, in a sense, available in unlisted and listed formats. The key difference is it can invest globally. So it can invest in CBA, ANZ bonds in dollars and euros, in US dollars and euros, and hedge them back to Aussie dollars. Floating rate high yield cannot do that. Another key difference is it has monthly distributions rather than quarterly distributions. Same rating, A+, basically the same portfolio, 70% senior, 30% sub, also recommended by Zenith. And I think it's the fastest growing active ETF in Australia right now. It's coming up towards 200 to 300 million. So that's YLDX. How does it compare to hybrids? Well, here's a side-by-side comparison. Our average credit rating is A+. The average credit rating on a major bank hybrid is BBB. Our yield is 7. Hybrid yields are 5.7. Our liquidity is vastly superior to the hybrid market. Our market size is much bigger. Our 12-month return is 8.2%. The hybrid market is 6.5%. And our 12-month volatility is about half the hybrid market. Now, one caveat, we expect through the cycle that the impact of the leverage, the 66% gearing, max gearing 75%, the impact is to basically generate return volatility that is broadly commensurate with the hybrid market. And when we look at these portfolios through stress events, we think the same volatility as hybrids broadly, and basically the same maximum drawdowns. Just finally, a couple of other things I want to mention. FIXD is one of the fastest growing ETFs in Australia. It's our active composite bond fund benchmarked against the composite bond index. It's a 5-year duration strategy here in Australia. Thanks for all the support from folks I can see in the room for FIXD. We've launched a global version of that product called Active Global Bond Fund. This is the product that global investor just allocated $1 billion to. To the best of our knowledge, we have the best long duration track record in the world, bar none, over the last year, 3 years, 5 years, and since inception. Our performance is the blue bar. The benchmarks are the red bars. The benchmark is the Bloomberg Global Ag Corporate Index. The duration of this portfolio is 5.7 years. We've typically beaten the index by about 180 basis points a year after fees. Duration is very topical. Duration is, frankly, probably one of the few cheap sectors that exist, period, across all asset classes right now. In our view, corporate IG is very expensive. High yield's expensive. Hybrids are very expensive. Equities are very expensive. Bank senior looks okay to potentially quite attractive, and duration looks okay. Another final solution I want to mention is our active sovereign bond fund. This is a really, I think, astonishing product. It's a purely sovereign solution, so it's only allowed to allocate to AAA rated government bonds. It's hedged to zero duration. Over the last 12 months, it's delivered 8% after fees versus the 4.2% RBA cash rate. There are a couple of sovereign managers out there that have raised a lot of money. We have very substantially outperformed those sovereign managers over every single period. It's rated recommended by Lonsec and Zenith. It's been backed by a number of big institutional investors. Australia's biggest insurer is the largest investor in this strategy. And unfortunately, my sales guys forgot to put it on our platform, which is pretty astonishing. And so I literally said to them a few months ago, how many platforms is the sovereign fund on? And they said, none. And so we're slowly but ineluctably looking to make it available on platforms. So have a think about that. It might be an option that's something that will help diversify your portfolios. The key point about the sovereign fund is it is uncorrelated with equities and bonds and credit because it is AAA rated government bonds hedged to zero duration. One wrinkle, we offer a long duration unit class. So there is a Ausbond Treasury Index duration unit class. These are the current yields as at 31 July across all of our key public strategies. Notwithstanding the RBA rate cuts, yields remain pretty healthy. We certainly have strategies that are yielding circa 7%. And HBRD, which is our largest ETF strategies, are yielding 5.6%. So in the ETF domain, we have YLDX, FIXD, HBRD, and FRNS, which is our cash solution. I think we're going to jump on a panel after Lockie speaks, but otherwise, in the meantime, thank you so much.